Good morning, everyone, and welcome to today's episode of The Curmudgeon and the Utopian. I had the wonderful Gene Epstein and Jeffrey Tucker here with me. Wait, where is Jeff? Wait.
I'm over here.
What? Jeffrey,
I'm
come
over
in here. You'll notice I am in the wrong screen today. I'm very lucky to be visiting Jeffrey at his headquarters at AIER, an awesome think tank you guys should check out. And today is not going to be a serenade. People have asked for songs from you, Jeffrey. So maybe if Gene doesn't stimulate you enough, then you could turn to the piano.
You two were Sacco at Freedom Fest that time when you did those duets.
Exactly.
Great.
Exactly.
Yeah.
Well, today we are
That's
talking.
you under my skin.
Absolutely. You got me. All right. Well, today we're talking about a serious issue. We always talk about serious issues on this show, even though Gene and Jeffrey are sure to go at each other in rather comical ways, as they always do. Today we're talking about the events that led up to Bitcoin. So you will know that in the Genesis block of Bitcoin, Gene is so shocked.
I don't know about the financial crisis, no?
Yes, that's exactly what led up to Bitcoin. Oh. So in the Genesis block of Bitcoin, you will know that Satoshi Nakamoto actually put the phrase, that it was from the Times newspaper in London. I think it was Chancellor on the brink of second bailout for banks. And that was, that was a really powerful statement for him to put into the Genesis block, because it really showed why Bitcoin was created. We're getting away from government control in money. So we're going to be talking about the financial crisis. We're going to be talking about the events of 2008 and all of the policies that led up to that. And I'm really, really excited about this topic, because this is one of my favorite topics to discuss, and actually how I became friends with Gene, because I saw him give a presentation on this topic and then asked him if he could explain to me more things about this, give me a reading list. So super interesting topic. Jeffrey, I'm going to let you come over and take your seat now.
That's great. Do you want me to use headphones, or do you think the sound is good?
It's totally up to you. I'm going to hop over onto my computer, and if you guys have questions, I'm actually in this one, going to be coming in and out, because I know that lots of people have questions about this. So I'll be popping back in occasionally with just a question to pose.
And you're going to the ballroom?
And I'm going to the ballroom, because we're in a castle. That is AIER for you.
A castle with only one ghost.
With only one ghost. So I'll see you in the next room.
To the smears of Gene.
You guys take over.
Yeah. Well, Jeff, I didn't know. I hadn't even remembered that it was that Naomi caught my presentation in New York on the fiscal crisis, and I actually remember that at Freedom Fest I did a workshop on it, and I saw your sweet smiling face in the audience taking copious notes. I guess you don't even remember that, but you were. You're
my teacher. I remember. You've been
playing to you, and you brought it to a new level. I want to start. I liked your essay. I saw 2 out of the 3 films that you listed. Interestingly, maybe we could start for people to sort of key off those films and what they did and didn't say. And actually, the documentary is the one I didn't see, and it didn't seem like you weren't making me very excited to see it from what you said about it. But the most popular film was The Big Short, and maybe you want to talk about that because you wrote about it, and I can add.
Well, so I liked the Big Short a lot. For one thing, it explained what an MBS product is.
Oh God!
I think it did.
Okay, please slow down. You can mortgage-backed security product. I hate these discussions where you lose people who are listening. Mortgage-backed security product.
Well, by the way, that's one of the problems with margin calls. It doesn't actually explain anything. So So Big Short actually explains it pretty competently. What mortgage-backed, commodity bundles of mortgages are. What it means to have a default risk rating attached to individual properties, and what happened with the excessive aggregation there.
Yeah.
So that was good. The other thing I really loved about the film, is that it made heroes out of people shorting the market. Which in the storybook of the left, the people who are shorting the market are always usually the bad guys.
Yeah.
And in this film, they emerged as the great, heroes. And it also showed, in a way, that it's the markets that are gonna fix themselves. The government didn't fix the problem. It was the traders that discovered the true source of values, and that's very nice. On the other hand, as you know, the film didn't deal with cause and effect very well. In fact, the goal of the Fed and subsidized mortgage companies and the how do you say, the the moral hazards associated with too big to fail were never really discussed in the film at all. So I think you're left with the sense that the cause of the crisis was just a bunch of greedy, out of control traders, and that's just wrong.
Yeah, okay, yeah, indeed. Yeah, Jeff, you've got it, Mighty. Your sweet, uncritical nature comes through, and talking about how The Big Short gave us this nugget of information and that nugget of information, except, of course, The Big Short is basically a great hoax. A great hoax in the sense that it really does try to tell us that the cause of the crisis was greed and deregulation. That's it. That somehow or other Wall Street had not been that greedy for a few years, and then they got very greedy, and so greed reared its ugly head. If you recall, we have the woman in the bubble bath who's giving us instruction on the fact that these crazy mortgage brokers just weren't getting enough business, and so they started to do more, and it was all just ridiculous in terms of its analysis. I analogize it to a movie that's about the torture of Abu Ghraib, and it's only about those crazy, weird kids at Abu Ghraib who were having fun. Now, those kids really were probably worth rebuking, but how about Rumsfeld at the top? How about the people at the top who created Abu Ghraib, who were really pulling the strings? It was pretty much on that level. That's why the movie, and by the way, something you perhaps don't know, but I happen to know, is that Michael Burry, played by Christian Bale quite well, it's a very well acted film. Michael Burry, the guy who envisions The Big Short, if you and I call him up, he will agree with everything that I just said. Michael Burry was nobody's fool, and he knew that it was a government-induced bubble. He certainly knows it now, and so it would be interesting to expose that fact. Because while it's a great story, the fact that it essentially misleads, blames it on capitalist greed and deregulation, that's why the movie was deeply offensive. But by the way, it did inspire me. I'm on a quest to sort of do my own Netflix-like series, which I hope you'll help me with. I've spoken to John Popola about it. We're not going to make any secret of it. If somebody wants to steal the idea, that's great. If they do it properly, a proper series in which we really depict what went on through story, through character, in which and John Allison of the BB&T Bank would be our main character, because John Allison was a guy who had read the free market people. He was heading the BB&T Bank, and he knew what was coming down while the crisis was brewing, and how he had managed to navigate his bank through that mess. That makes for a great story. And what interested me about The Big Short is the way in which you can dramatize things and get away with lecturing people to the camera. It's consistently entertaining, the film, and yet there's a lot of didactic lessons. Professor Richard Thaler comes on and starts lecturing you. And the bubble bath woman, of course, you got to make it naked. Like Penn and Teller, when they do their shows called Bullshit, plenty of naked women. You got to have that. But anyway, that's why the movie was at its core a hoax. And Michael Burry, the character that Christian Bale plays, knew that at the time and knows it now. But
let me ask your view about something here, because I've talked to people who, were on Wall Street at the time and started in the industry, 3, 4, 5 years earlier, when mortgage-backed security products were a creation, innovation, and they defend these products as being tremendous, derivatives, that are wonderful, great financial innovations in themselves. So, what is your view towards that? I mean,
like you get them at all. No. Well, Fannie and Freddie, of course. I mean, when Barney Frank, Congressman Barney Frank, who was, Frank Dodd was named after him. When he was condemning, there's a movie called Inside Job, by the way, a documentary that won an Oscar for best documentary, in which Barney Frank is inveighing against these derivatives that you can package mortgages and sell them to somebody else. But of course, I mean, this would be like, what's his name, Bernie, who was the guy who started the Ponzi scheme? What's his
Madoff.
name? Madoff.
He made off
Like
with
Madoff.
a lot of money.
This would be like Bernie Madoff condemning Ponzi schemes. I mean, Barney. But the point, however, I digress. To answer your question, is that there is nothing at all wrong with derivatives. We have derivatives in the credit markets. We have derivatives in the auto credit markets, auto loan market. There's nothing wrong with laying off risk on people who want to bear that risk. But obviously, that's shooting the messenger.
The commodity. There's nothing wrong as such with the commodification of debt obligations in an aggregated form. I mean,
there's nothing wrong with that. I mean, itself, but obviously, when you have now let's cut to the chase for the audience. The sine qua non that without which the crisis and the horrible events of 08 and 09 would not have happened. The sine qua non was the government push, mainly starting under Bill Clinton, a little bit George H.W. Bush actually signed
for home ownership.
Home ownership.
Exactly.
Yeah. The idea that everybody should own a home, and it would not cost. And when I asked a commentator who I highly recommend named Una MacDonald, who's a Labour MP from Britain who wrote about this, when I asked her, who would you indict first? For what happened? He said, well, obviously Bill Clinton would be indicted first, because when he said it wouldn't cost taxpayers a dime, it cost us trillions of dollars.
Yeah, but you remember, Gene, though, you got it. I mean, you've been around a while, in these circles too. Yeah. But do you remember under the George Bush Senior, whatever the guy,
Bush,
whoever it was, the first Bush. You remember his? Do you remember that I think it was he who appointed Jack Kemp as the head of HUD.
Did he?
Was that
way back? I guess you were.
Or was that the second Reagan term? Oh God. Yeah. Anyway, you have to go. But when Jack Kemp, and there's many things to love about Jack Kemp, but he himself, got confused about this issue.
Oh yeah.
And because he was using all his powers that he had at HUD to promote this idea of ownership, and the idea is that if you're renting a house, then you really don't have a stake in it. You're not really living the dream.
Well, that's true. If you're renting your labor to some boss, you don't always have a stake in it. But go ahead, yes.
Yeah. So, but there's
stake in the company.
This putting down of renting as if it's like an inferior form of life. And so you should, and so it's just weird. So you're supposed to actually have, if you're going to be a real American, a mortgage on a home, which is funny to me because actually, a mortgage isn't ownership either. I mean, basically, you've got a debt obligation that you're paying to the bank, and the bank is, for a timed period up to 30 years, the actual owner of the house.
You're mistaken.
And they're basically
when you hold a mortgage, Jeff, you have what ownership is a bundle of rights, and the key point about ownership in particular is that if you buy the house for $100,000, you're free to sell it at any time. That's a right, and you're free to sell it at the price, and all the proceeds when you sell it go to you. So that's a key.
Well, but then
and then if you want to renovate the house,
that's true.
And then you can. The bank doesn't tell you not to. So that bundle of rights does reside with you, and the fact that the house is collateral on the debt is something else. But I would say you do own it. And I by the way, interesting logic. It's a bit of an interesting digression here, but I would tell you that certainly. One key point about home ownership versus any other kind of investment is that most other kinds of investments, especially long-term investment in the stock market, generally does a whole lot better on almost any time frame than owning a house. However,
but we didn't. I don't think we knew that. We knew that.
Well, a lot of people don't realize that because they never look at the data. However, obviously, which isn't to say I got real estate rich through blind dumb luck because I bought co-op. swaps when the market was rising in New York, and I sold them. And so that happens. However, the other key point, however, is that we have to live somewhere unless we want to live out in the street. So we have to put a roof over our head. Now, so we have to either rent or buy. And there is an argument for buying. And the argument for buying, by and large, is actually partly what the government does. The government gives you a tax deduction on the mortgage. However, when you are your own landlord and you're paying rent to yourself, you're presumably earning some kind of landlord premium. And the government doesn't tax you on that part of it. Now, there is that. That said, of course, because people go so crazy for buying, you often find that houses are way overpriced. However, there is some argument for it. However, you are right at the end of the day that, for example, in the advent of 401ks, you can have four savings. Just start up the 401k or the key or IRA if you're independent, and you can save your money, and it's much better to rent. Most of my lifetime I rented, and so you're absolutely right that it's a religion, home ownership. But getting back to Bill Clinton,
real quickly on this point, just because you said there's the advantage of ownership is that you can sell the place. But the advantage of renting is that you don't have to sell the place.
Oh yeah, no. Well, excuse me. No. What I said, all I said was that you have ownership rights in your ability to sell. Yeah. But you're absolutely right. The point is that indeed, the fact of the matter is, for example, I bought. I think a few anecdotes will help with respect to this religion about home ownership. I know. I bought my mother's. My mother bought a condo in 1965 in Century Village, and a number of years later for $35,000, and a few decades later, I sold it for $15,000. That was a few decades later. The same thing. Far less, and people in the Midwest. I know I have a friend right now who's selling his home in Ohio, and he's selling it for less than he bought it for. So the fact of the matter is that this religion, that real estate can only go up. It's just a bi-coastal.
Listen, it goes back. And by the way, it was the second Reagan term when Jack Kemp was the head of HUD, and he promoted this idea of ownership, and that if you're renting, it's like socialism, whereas if you have a mortgage is capitalism.
Psychological virtue, one of the virtues which used to be the case about home ownership, is that it's kind of a forced savings. You do accumulate equity in the home, and some of us are profligate, particularly us baby boomers. But since we do now have very well established, for most people who have jobs or independent people, savings plans, then that works much better. It's much better to rent and then to use the money, any surplus, on accumulating assets.
Totally. But I know you want to talk about the changes that Clinton. But I mean, you have to keep going back in time. I mean, housing ownership was promoted by Eisenhower. It became a big deal, under Roosevelt, and even in the 1920s. And this is the way Americans are, right? I mean, it's like as soon as we can do some new thing, we come to believe that it's the thing that we should all do, And it was like back in the 1890s when people began to assemble home libraries. It's like, oh my God, I better buy 10,000 books, So it was in the 1920s when regular people could start buying houses. It was like, well, you damn sure better buy a house or else you're not a real American.
Maybe correct me. I haven't looked at this. I know, but Jeff, I will tell you that I know, for example, that the home ownership rate, and by the way, Canada has never had the 30-year mortgage. I'm almost positive the mortgages tend to be 10 years, and yet they have a home ownership rate of more than 50%. I believe that some of the better, Sweden, other places, the better off European economies, I think there's a fairly high home ownership rate. There is a tendency,
and shorter terms for mortgages. I mean, back in the 20s, 7 years was normal. So this idea that you're gonna be paying on your house for half your life expectancy is just crazy. I think it is. I mean, maybe market would generate that, but
let's agree. I heard that there's a guy, not appropriate for him, a real expert in the field who actually co-wrote the book with Gretchen Morgensen. I'm friendly with him. I think his last name was Rifkin anyway. He co-wrote a pretty good book with Gretchen Morgensen, who's now, I guess, at the Journal, a very good book about Fannie and Freddie. And I heard him lecture, and he's talking as though if we do anything to abolish Fannie Mae and Freddie Mac, that we've got to step into the breach to make sure that the mortgages are available so that people can own their own homes. Of course, I said that. Then I got up. My first question, I said, this is a faith-based lecture.
Yeah.
Where are you coming from? Are you a rabbi philosopher that everybody's got to own their own home? Or are you an economist? It's a choice between renting or buying. There's nothing wrong with the choice of renting. Are you out of your mind? And it's amazing. These economists who think they have their heads screwed on right, believe in this faith.
And even last week, the Wall Street Journal ran an article about how renting is up 20%. I can't remember the numbers, but it's far higher now than it was, say, 10 years ago, which makes perfect sense. Yeah. People are not stupid. They now realize that there are better things to do with their money than buying a house. Maybe you want to buy a house, but there's an opportunity cost there.
I'm not sure that. I have to say, the home ownership rate is now, it was up to nearly 69%, and Clinton wanted to get it to 70%, and then probably if it got to 70%, Clinton would have said, let's go for 75.
Yeah, sure. What's the right rate? What's the right rate? But
it's fallen to 64%, and I had a great call. I said, at Barron's, I made a lot of money for the clients, because I said, for the readers, I said, buy rental REITs, real estate investment trusts that invest in rental properties, because the home ownership rate is falling and the renter nation is starting up. So I made a very good call for a couple of years on that one, because the flip side of the home ownership rate is which is now down to 64%, is of course now it's up to 36%, the renters. However, Jeff, the jury is still out on that, about whether this American dream, the American dream is owning your own home. That's the religion. However, look, the young people who might start buying homes, who are pushing 30, have a lot of student debt. So maybe that's why it's not happening.
Sure,
in other words, if you're saying people are wising up, you may or may not be right.
Well, I'm just telling you that, like, just a quick example from Atlanta, right? So I rent a place in Atlanta. I'm like, maybe I'll buy. Well, once I did all the numbers, I mean, it turns out that once you consider all the closing costs, the interest, and the down payment,
on the money.
and then also, I don't know what it's like around the country, but certainly in Atlanta, you cannot buy a condominium without paying very high monthly fees for your service. For service fees. I don't know, condominium renters, condominium owners associated, homeowners associated. Shit, I don't know what it is, but it's like between $500 a month.
The maintenance, exactly. The maintenance is, and that gets to a key point, Jeff.
And once you do all the numbers together, it turns out that, like, oh, whoops, it's almost the same as renting, which is what you would expect in a cleared market.
Yeah, exactly. But and one key point is this: you're absolutely right that if you buy into a co-op or a condominium, they have upfront, this is the maintenance cost. However, what people miss when they're, especially when they're first-time buyers of homes, they're thinking of buying, and they look at the cost of renting, and they look at the mortgage and so on. The one thing they don't realize is an old saying from a lot of homeowners I've met, mostly Jewish: homes eat money. They forget, because the maintenance cost, the cost of repairs of the rooftop and all the rest of it, are not in the price. They don't know that from bitter experience. I just spoke with a homeowner the guy selling his home in Ohio.
I know.
Don't I know it, that homes eat money? And they forget that. They don't put that part into their calculation because it's not explicitly stated, because they're buying a detached home.
I mean,
the big mistake they make. The big mistake.
Oh, and the homes are constant, like the way, as you like to use Jewish expressions, I'll use Catholic ones. But you know how in Catholicism everything's going the way of all flesh. We always say, we will go the way of all flesh. Which is to say, the mortality is baked into the structure of the world, right? From ashes to ashes, from ashes you came, to ashes you will return. Dust to dust, and so on. So it is with homes. I mean, they're always falling in value.
They're eating money. They're always eating money. They're eating money. They're eating money. They have to be renovated. They're massive businesses. If you're a roofer in Long Island, chances are you're a multimillionaire. The costs of people do tend to want to maintain them. keep them in decent shape.
Yeah,
and they pour fortunes of money into it. And that's the one thing that first-time buyers or even second-time who haven't had the experience over a long haul don't realize and don't put into the equation. But as you said, when you do buy a condo or co-op, the number stares you in the face. That's the advantage of recognizing that. Okay, but the point is, but Jeff, the point is that I think we taught our young listeners a lot about these choices, but I want to shift gears to the main point, which is that the story really does, by and large, begin with Bill Clinton and Andrew Cuomo, who was
that's when you would say the bubble.
The bubble began where Clinton, recognizing that Clinton wanted to make his mark in every possible way, just like any ambitious president does, and so this was the way to do it. Where the home ownership rate won't cost taxpayers a dime. So he tells HUD to lean on Fannie Mae and Freddie Mac, which are government-sponsored enterprises. It's traded on the New York Stock Exchange, however, basically beholden to Congress. HUD, if they wanted to continue to get various privileges and the implicit guarantee that their debt was government-backed, they wanted all these rights, then they would have to comply to HUD standards. And HUD maintained this request. That they bought mortgages. They didn't originate them. So that's why, of course, the mortgage derivative market became ugly, because they bought the derivatives. They bought mortgages in the secondary market. But although, of course, if Angelo Mazzillo, a private mortgage banker, was originating mortgages, he knew that the next day he could sell them to Fannie and Freddie. So it was almost though Fannie and Freddie were almost originating them. However, Fannie and Freddie are told 1 year by HUD, 1/3 of all the mortgages you buy this year have got to be certified as being mortgages being given to people whose incomes is under the median. And it went up to 50%. So year after year, they have these requirements that you have to buy, the mortgages you buy, 50% of them have to be held by people under the median income. So very quickly, they began to find that they had to loosen their standards because it's very difficult to find people under the median income who qualified for a mortgage. So that's why the standards began to loosen. No down payment, no ninja, no job, no background, no assets. Suddenly they were giving mortgages away to people who could not possibly pay off those mortgages over time.
Let me ask you something very specific about what you just said, Jane. And I'm not doubting a word of what you said.
Oh, okay.
But let's just do a kind of all else equal kind of experiment. If those mandates that pertain to underqualified borrowers never existed, do you believe that we would have never seen the housing bubble? In other words, is that a necessary and sufficient explanation of what happened? I mean, I tend to think that while it matters, it doesn't matter that much. Okay, just a moment. Let me just. I
want to put one further piece of flesh on the bones. It wasn't just that; it was also that the private sector mortgage bankers who were selling to Fannie and Freddie were encouraged to induce people who were creditworthy to refinance at very low down payments, to buy more homes. And then what happened was that, let me finish the story, which is important to bear in mind, is that then with all this new demand coming into the market, prices began to rise substantially, 10% a year, 15% a year. And so this became a self-sustaining bubble because you could continue to refinance into a rising market because of the fact that the excess demand created by this initiative started the bubble going. And so all of that happened. And FHA participated, although to a minor extent, many maybe in Freddie Mac were the main participants. Then the private sector got excited about this. Also, it was underwritten by the Federal Reserve. Alan Greenspan has kind of an odd mixed record about it. However, most egregiously, he was encouraging the mortgage bankers to sell adjustable rate mortgages at lower rates, adjustable rate mortgages that only lasted 2 or 3 years, and then suddenly the rate would go up. He was encouraging them to push that. They began to happen. And then after the 2001 recession, Greenspan felt especially concerned about keeping the recovery going. And
that is true. That is so true.
He put the Fed funds rate at 1%.
That's right.
and that also especially sustained the adjustable rate mortgage market because it was more key to the short-term rate. So all of that happened. Now, the answer to your question is yes, in thunder. All of that, the housing bubble, and also the fact, an important confusion here is that a lot of mortgages fail that were being held by people who otherwise would have seemed to be credit worthy, but that's because they were encouraged to get in over their heads as well. So
I don't want to get well, you made a point that I don't want to pass over too quickly because honestly, and I haven't read everything, I haven't listened to all commentary on this, but you're, I think, the first person besides myself who has identified 2001 as a very important turning point in the loose money policies of the Fed and the desire to kind of use artificial stimulus to rebuild American prosperity after 9/11. So this is, there is a real thread between the events of 9/11, the Federal Reserve's and the Treasury's policy and the government's policy response to that, which is, we can't let the terrorists win. We're going to be prosperous. We're not going to let you take away our happy lives. And so we're going to make sure that doesn't happen by just like opening the spigots. And you can see, you know, even in the days following 9/11, the Fed's going nuts and printing money like crazy. You can actually see it.
Well, indeed. I mean, pushing the I think your point is quite valid. I want to put a few nuances in here. I just published an article in which I go after, I think, the real ultimate Keynesian, who is not Paul Krugman, but Joseph Stiglitz, the other Nobel Prize winner.
Oh, yeah, I saw that article.
Joseph Stiglitz collaborated on a paper for Fannie and Freddie in 2002 with the Orszag brothers. The Orszag guys, a couple of pretty well-known bureaucrats. But anyway, Stiglitz and the Orszag brothers concluded in 2002 that Fannie and Freddie had zero risk of defaulting. They were sound as a dollar. Now, I happen to know from the data uncovered by the American Enterprise Institute, a complete dossier, that by 2001, those mortgages were already beginning to look risky. So clearly, you would have, any responsible person who looked at the book would have told Fannie and Freddie, you're tipping over the edge here. You're supposed to be setting a standard for quality and safety, and you're headed in the reverse direction. You should do something about it. But I hasten to agree with you, by the way, because they have a radioactive isotope in the book has Fannie and Freddie's mortgages and in the private sector has been charted. It was not until 2002, 2003, and 2004 that the risks really began to soar.
And we couldn't face it. We couldn't face it for reasons of national pride.
Paul Krugman is actually writing in 2002, 2003 that we need a housing bubble. We need a housing bubble. That Greenspan's got to bring about a housing bubble. Something again in black and white. He's calling for a housing bubble, and he's denying it. And you're absolutely agree that okay. Gene, let Jeff finish his sentences. Yeah, okay, I'm going to do that.
No, it's fine. I'm interrupting you. What else are you going to do?
I have to just finish this discourse a little bit. I'm agreeing with him that indeed that's when Greenspan put the Fed funds rate to 1%. And if you actually read the minutes of the Federal Open Market Committee, which handles these things, anytime he mentioned the housing market, it was always with great concern and great assurance that they're doing their part. The housing market is doing fine. This is important. Right. So it was by his own testimony that it mattered to him.
Well,
okay.
And
go ahead, Jeff.
No. So, and you remember back after 9/11 happened, I think the president was George Bush or somebody like that. I can't keep these Bushes straight. But his solution to get back at the bad guy terrorists who had done this to us was to go out and buy things. I mean, he actually said that. So there was this wild national Keynesian frenzy. It's like, buy things. Well, what should we buy? Well, just a lot of things. Well, what about really big things? Yeah, like houses and cars, and just buy a lot of stuff, and that could create prosperity. So this ethos developed between 2001 and the end of the bubble. That the answer to all of America's troubles was for you to spend as much money as possible, and the government's going to make it possible for you to do that. Now, I don't want to finish this this particular podcast without both of us admitting things about which we were wrong at the time.
Oh, yes.
Okay. So one of the things I was completely wrong about was that the Fed's monetary policy response was going to lead to inflation, and we can talk about it a little bit. And I was completely wrong about that because I didn't understand I didn't understand the implications of the Fed paying interest on bank reserves and what that would do to the money supply. And that's because I was stupid. And I learned, all right? I learned, and I'll never make that mistake again because I was stupid and I learned. But I'll tell you something else I was wrong about, Gene, and I wonder if you're interested in this. As we're going into 2005, 2006, people like my colleague Mark Thornton was saying, oh, it's a housing bubble. I wasn't sure there was. And I tell you why. Because I thought that the market was working better than it was. And by that, I mean this. I didn't really believe that Fannie and Freddie were actively participating in a market that was widely perceived in financial markets to be too big to fail. Like, I didn't actually believe that. I thought there was that the market signaling was not so bad that it could create a bubble on the scale. And I thought maybe there was a possibility that all this was sustainable. After the collapse, of course, it turned out to be true that there's a moral hazard baked into the entire mortgage industry that I didn't perceive to be there because it wasn't explicitly promised, but it was widely perceived to exist. So I'm wondering, what was your perception at the time? Did you know, in fact, that the federal government stood ready to bail out the housing market? I don't think I did.
Oh, well, okay. Let me start with my big mistake. I knew there was a housing bubble. That's in my columns. You could trace that. And the reason I knew whether there was a housing bubble is that any measure of house prices was showing that, I mean, when you have house prices, according to any measure, rising by 10% a year, and then when you trace how house prices normally rise, then it's fairly clear that there's a price bubble. Now, so that was clear to me, and I could have shown that to you.
I don't think
you
could have said
10% a year for house prices. Come on.
So what?
What? Okay.
So what? How do you know that's supposed to be 10%, 20%, 5%? How do you know?
Because there's an historical, because the fact of the matter is that just the very point, which is that about comparing investing in houses over the long term versus the stock market, is that house prices generally rise about 2% a year on average above the rate of CPI inflation. They rise.
Maybe that was a mistake. You need to read your Mises. There's a difference between theory and history. There's a difference between theory and history. I mean, just because something went up 2% in the past, maybe that was an error and it should have gone up 10%. I just don't believe that you can know that based on the numbers alone.
Okay. I would only tell you that if the pattern is very persistent, then you could tell that. I mean, what would you also be able to say in terms of this pattern? You would say that there's a certain, you can see how, because housing requires land, because housing is a very labor intensive activity. It's not, you don't manufacture. You could see how the housing would rise a bit faster than the price rises of other kinds of goods. You could see that. However, you could also see that when prices rise, there's going to be a supply response, and so that's why the idea that housing could be a better investment in the stock market, that sounds ridiculous, because the stock market is built on rising profits. So okay, I would say, but apart from that, again, I would only have told you that, of course, in the background as well, I knew that the government had a fairly active policy.
Okay, that is a qualitative issue.
But still, I want to look at the numbers and show that the price is rising faster than really makes sense. So I recognize that. And then when the price bust came, when the bubble burst, which was in 2006, by the way, when it began to bust, and then when that part of housing, that part of gross domestic product that consisted of housing began to really slow, then what I was impressed by is that the non-residential portion of GDP in 06 and 07 actually began to rise faster. By 07, it was rising faster than in 06, the non-residential portion of GDP. So I said to myself, well, housing is going bust. But the one thing that my Austrian and free market friends miss is that there are a lot of cycles that are induced by the Fed and induced by a screwed up way in which the government runs our markets. However, not all of them can bring down the economy generally and cause massive unemployment. So I decided that this bursting bubble was not going to be sufficient to bring about a recession.
Yeah.
Well, you just didn't.
I see. Okay. You didn't understand the extent to which the financial markets were exposed in these MBS
precisely,
products.
And partly because Fannie and Freddie were misreporting the data. By the way, Inside Mortgage Finance, which is the Bible of the trade, was misreporting the data. The extent to which these high risk mortgages, leveraged plays were out there was not well known. Now look, others got it right, so therefore I can excuse my error.
Well,
but it wasn't.
And your comment. So, and the other thing that people were saying at the time, this is 2004, 2005, 2006. This can't be a bubble because housing prices are tremendously localized. I mean. It's it's like I've got a house on a particular price, and people used to say in the industry it's location. Everything's priced according to, what are the public schools in the area, how big is your square footage, blah blah blah, what's your access to shopping and so on. And so there's no such thing as a national market for houses. There's only a house or maybe a neighborhood or maybe a town. And that's true in theory, unless you have these big national institutions like Fannie Mae and Freddie Mac and the Federal Reserve all uniformly cobbling together policies to boost housing. That creates a kind of financial nationalization of an industry.
Well, okay, I do want what you said is actually, now it's more true than you think, what you just said. The fact of the matter is, it is true that if you were to disaggregate the average housing prices and look at them by region, then you would have found that the middle of the country was not really feeling a bubble by and large, and that it was essentially very concentrated on the coasts. But of course, obviously, the coasts are pretty massive. Lots of rich people, lots of money, lots of mortgages.
Well, even
lots of housing. But you're right about that. But it's almost true that whenever you look at a stock market bubble, and a stock market bubble, you can. By the way, I've come to think of it. I want to mention one other thing that there is there's the price dividend ratio or the price earnings ratio. In other words, how high are prices compared to dividends or compared to earnings? Similarly, you could measure a price rental ratio. In other words, the how high are prices compared to what you can earn renting. Really that was another indication of a bubble. But the point is, I want to agree with you that this could have been the first real housing bubble in history for the U.S., at least in recent history, recent memory, because indeed, obviously, it was so powerfully government induced. But it is true that I guess that people who wanted to deny the housing bubble could point to the fact that if you disaggregated, you'd find that it was unevenly distributed. They would find that if they did. Although probably, if you looked at a stock market, if you look at any kind of stock market bubble, you could probably disaggregate and find that, there's like these few hundred stocks that are not affected. Disaggregation can always show you something, and it's important to do. But they have they measure the dispersion effects. However, it was true in enough places, especially on the west and east coasts, so that it was a real source of potential concern that there was a housing bubble. But again, what I did was I underestimated by far the damage it could do to the economy. I didn't know about all of those mortgages that were held.
Well, let's talk about October of 2008, because this is the period in which it became just overwhelmingly obvious that we had a serious problem, and that it was a major problem. It wasn't just about house prices; that everything was being threatened. And you and I were involved. There was a big debate at the time. Should Congress pass TARP,
Yeah.
which, as I recall, was $400 billion or something like this. Now we're moving into an election. We've got Bush coming out, and there's a big contest between Clinton, between Obama and somebody else. Who was it?
And Brian McCain, I guess.
Yeah, McCain or something.
Yeah.
And so,
First election McCain. Yeah.
So we got a lame duck president, and he's kind of, but he's pushing really hard for TARP, a $400 billion bail.
Yeah.
I was saying at the time, we shouldn't do this. This is we should just let these institutions fail. Lehman failed, but then everything else was kind of rescued. And there were even Austrians at the time that were saying, "Are you out of your mind? Like, this is it.
Yeah.
This is it. We have to save this country's institutions, or else we're all toast."
Oh, wow.
And at the time, I was in charge with determining sort of the editorial policy of the institution I was working for at the time, and I held a hard line on this. I was like, no bailouts, no bailouts, no bailouts. But the country was in panic, and it was created by Bush. And I tried to look this up, and let me ask you if you remember this. I tried to look this up, and I couldn't find any evidence of it, but I distinctly remember Bush warning something at a press conference one time, that if we don't pass TARP, it's very possible that you will go to your ATM and try to pull out your cash, and there won't be any cash in there. Do you remember that comment?
Oh, yeah. Well,
okay.
Excuse me. Sure. I mean, by the way, you speak of Bush, and let me speak to what you just said. George W. Bush, the younger, he picked up the ball from Bill Clinton with enthusiasm. There's a great video of him saying, "This I love this irony, by the way, that Paul Krugman, as it's pronounced, said, how ironic that those free market people are saying that the government induced this bubble because they cared about inequality." And the really joke is that's Bush. George W. is saying exactly that thing. He said, "We have inequality of home ownership in this country." I can't imitate his voice. He said, and we want to set that right. This is George W. Bush saying that. And he said, and then, "We know you don't have the down payment. We're going to give you the down payment," is what he's saying. And so this is enthusiastically picking up the ball about HUD. Okay,
this is
I just wanted
2004,
I wanted to address what you just said as well.
Yeah.
That certainly what happened was that Bush, his advisors, Bernanke at the time, and Geithner, the Treasury, they read the Riot Act to him. They because obviously the boy was scared. He's obviously just a trust fund baby. Doesn't barely knows the difference between supply and demand. And so they told him. And then of course there's the famous line is we have to intervene in the free market in order to save the free market. You know, it oddly echoes. We had to destroy that village in order to save it. Back to the Vietnam War. And so I didn't even know if he was echoing that. This goddamn idiot. But by the way, I want to separate one thing from another, which is to say that
before you do that, I just want to say a huge thank you to Brian Keller for using the super chat and sending us a squirrel unrelated carry on.
Okay, and then could I finish with okay? Oh, okay. Thank you, Naomi. Am I still on? Okay. Yeah. Okay. And all right. The point is that Fannie and Freddie were put into conservatorship. They couldn't pay their debt. So and a lot of debt holders from Japan, foreigners, and others who had to be bailed out. So their creditors were bailed out, but their mortgages weren't. And what was happening, of course, was that when prices start collapsing, then obviously you're underwater, and that's the cascading. That's the other part of it, which is the snowball cascade, which is that suddenly if you're underwater, then you can't. Then you walk away from the house. The mortgages then fail in increasing numbers, and the houses get dumped even more, and the prices fall.
Actually,
so that's what happened.
That was a delightful aspect of all of this stuff, was to suddenly see these contracts that the banks had over the mortgage, these mortgage holders with the contracts of the owners, the ostensible owners, we're like, you better pay your bills or we're going to take your house. And then people were like, hey, this is great. I don't want to pay my bills because it's like burning money. What's the point of this? I'm paying for something that if I didn't own it, if I resold my house now,
it would be for less than the mortgage.
Yeah, it'd be less than the mortgage. So there's really no point in paying this. I'm literally just burning money. So I'm just going to walk away.
Yeah, well,
and then you, Mr. Banker, get to own the house at whatever the fair market value was, and then so that was fun to watch. I enjoyed that, and even the libertarians
enjoy that. Okay,
yeah, I had a big debate about like, is it moral to do this or not? And I would say it's totally moral. If it's
I want to say one thing that actually my broad framework is this: you raise the issue of TARP. And then, of course, there's the issue of the huge deficits that Obama ran and all the rest of it. That I believe, for example, I believe that Bob Murphy, who's has written best about this, and I think has shed a great doubt and really looks at it under a microscope and argued that did very little good, did mostly harm. The predictions about what, but all of that. However, I think it's important to make a distinction because we've already touched upon a massive subject. The distinction is this: that the two halves of the debate. One part of the debate is what caused the crisis, and that's the government's housing policy. What brought it about? But the second part of it is: did it have to be as bad as it turned out to be? Did the government do too much? Did it not do enough? All of those issues are totally separate. The point is, maybe it would not have been the greatest recession. Maybe it would have been a mild recession. But clearly, it was pretty massive, and an economic recession was almost inevitable.
Well,
but that's a different question. The housing, but when you raise the issue of TARP, I don't think we're going to have enough time to get into all the nuances. But I want to make one point. Amazingly, there are lots of knowledgeable people who think that when Fannie and Freddie were bailed out through the conservatorship, that they were no longer a cause of the problem and they were taken off the table. What a colossal error. All that really happened was that the creditors were bailed out. Those who had lent money to Fannie and Freddie. Fannie and Freddie could pay its bills, pay off its debt to its creditors. The mortgages were not protected. The mortgage holders, the individuals who could not pay the mortgages, they weren't bailed. So all of the mortgages the Fannie held were basically contributing to that cascading problem, to the collapse. So that's also key. So my only point is that the sine qua non was the housing bubble. But people often confuse the one issue with the other, which is that a whole lot of economists say the Fed wasn't aggressive enough in trying to when the 08-09 happened.
It was a weird policy. I mean, the Fed's response was very strange, and you had to understand a lot about banking institutions and how they work and the relationship between the loan market and hot money on the streets. You had to really have a high level of understanding to foresee that the consequences of the Fed's response was not going to be hyperinflation. In fact, it was going to be probably the opposite, because while there was a gigantic, unprecedented increase in the money base, the Fed started paying interest on reserves of the banks, and so and actually pulling money out off the streets.
Okay, but at least, fair enough, Jeff. But at least, I assume you'll respect my point, which is that the Titanic hit an iceberg. That's why it sank. Now, did so many people on board have to die? Well, not if they'd been lucky enough to communicate with a ship that was not far away that could have saved them all. But the iceberg cause remains. Did it have to be as big a disaster as it turned out to be? A separate question. Had they been luckier, had they been smarter and communicate, so on. And so similarly, the government brought about the housing bubble, and the bubble caused a recession. Did the recession have to be as bad as it turned out to be? A different and separate question, very complex and difficult for us to get into over the next few minutes.
Gene, let me say something about this, because I wonder if you agree with my perception here. Yeah. So my formative years in political economy, I remember vaguely that in 1982, Reagan had inherited this, he had inherited. Well, he brought about a recessionary environment, I guess you could say, by urging a tamping down on the money supply. We had Volcker at the Fed. There was a
22% Fed funds rate. 22%.
Yeah, and it was a massive restriction. And Reagan would go on national television and say things like, "I know there's a recession right now, but we have to have this recession in order to build a good, strong foundation for recovery in the future." So there's a tax cut. And he explained to the American people, recessions happen when mistakes, as a consequence of mistakes in the past. But let's give it a year, give it 18 months. Let's let all the bad investments wipe themselves out. Just be patient, and we're going to have a beautiful grounds for prosperity in the future. Now, that was, I think, the last time in American history we had a president say anything like that. And what happened after 2008 was a completely different ethos. Now, after 2008, you might have had somebody like Obama, or anybody, it doesn't matter who it is, somebody of some important voice in America, public intellectual in America, to say, hey, sometimes markets get out of control through bubbles, and when they pop, there has to be a readjustment. There's the shifting of labor resources. Capital has to move from where it's malinvested to where it's more wisely invested. We're going to have to go through a period of suffering, and then we can lay grounds for new prosperity. But do we hear that? No. It was like the devil has arrived in our Garden of Eden. Let's hunt it out, stamp it out, and kill it so we can get back to being awesome like we're supposed to be. There was zero tolerance for the recessionary environment. Do you remember this?
Okay.
I mean, there was no talk. Like, nobody said anything like, yeah, it kind of sucks right now, but it's going to get better later. No, it was like, it sucks a lot right now, and the government is going to make it unsuck through massive countercyclical measures and pumping money and doing all kind of things. And it was a completely different ethos. So like 2008 was the opposite of 1981, 82.
Okay. Well, yes, but I want to, please, Jeff, I want to correct one point of yours, which is that if Obama had not been Obama, if he actually knew something about what had been happening in the world, then this would have been very odd statement that he could have made. He could have said that we have a recession on our hands, and you know who caused it? Bill Clinton and George W. Bush, because Bill started this housing bubble going, and my predecessor George picked up the ball and kept it going, and HUD and all of these other people whom I'm not responsible for. I wasn't around at the time. I'm just taking over now. I only joined the Senate recently. They brought this about.
And, he should have said that.
So that's what he could have and should have said had he been speaking realistic. But please don't say that he could say, "Oh, the markets are screwing up." Of course, that's exactly what he did imply. That it's all the fault of capitalism, all the fault of greed and deregulation. So that's what he could have said. But getting back to Reagan, since you mentioned Reagan, in that particular case, it actually was a little bit more plausible. What Reagan would have said that would have been more pointed, maybe he did say this because you were only paraphrasing, the inflation, price inflation was raging in the double digits. And when that begins to start, it can build on itself. It was beginning to feed on itself. In 10 years, we could have had triple digit inflation. That would have been conceivable. And Volcker understood this, and he decided to break the back of the inflation by hiking the Fed funds rate, the short-term interest rate, which we just mentioned had been at 1% under Greenspan. He hiked it to 22%.
Unbelievable.
He consciously brought about a throttling, actually, of the housing market, of the interest rate sensitive sector, and intentionally brought about a recession. It turned out to be worse than he thought. Do you mean?
Yes, we should. My colleague here at AIR, Pete Earle, just did a kind of a 100-year roundup of presidents and the things that they told the Fed to do, because recently Trump was lecturing the Fed on what they should do, and the New York Times said, this is unprecedented. And so my colleague Pete Earle shows that every single president has done that. But here's what's interesting about this in his analysis. Almost every president has in fact done this, but only one president urged the Fed to adopt a tighter money policy.
And that was Reagan?
That was Reagan. So that is amazing.
Actually, that's an interesting nuance. But I like you contributed a lot of fascinating nuance to this. Now I'm giving the broad thing. Your nuances are great. Indeed, what's interesting.
Why? That's like the fifth time you use this word nuance in this podcast. Why are you seizing on this term? Maybe sometimes you find a new word and you just use it. Good point. I'm not going to use it anymore. You have some interesting perspectives. But the fact of the matter, what's interesting is that Reagan, for all the fact, that he sounded sometimes like a slightly dim-witted actor, he actually was unusually well-read in economics, and it's very. I always thought that when Volcker, who had obviously some sophistication, understood what was going on, and Reagan gave him a green light.
So he persuaded Reagan, I got to do this. But now you're saying very possibly it was kind of a collaboration, that Reagan probably was at least the smartest vocal about this. And it's a very odd fact about him that Reagan had produced a lot of papers on economics, and he seemed to actually know a lot about this stuff.
He knew the protectionism was bad, that money should be sound. I mean, he had, basic.
The first and only president ever actually knew something. Well, maybe there's some others prior to that who knew something about economics. But fascinating. But my only point, though, is that again, if Reagan were really being honest, and maybe he did say, we could look it up, I guess, that we have to end the double-digit inflation.
Yeah.
We have. Because otherwise it's going to really end badly.
Yeah, and I don't think we'll ever see the likes of him again. I mean, I felt like when Obama was declining to tell the truth, or because he didn't know the truth, I thought, oh, Jesus, we'll never have again a U.S. president to say something like tremendously honest to the American people, that something like, we're in a recession. And there's something good about recessions. They make us honest. They clean up malinvestments. We have to live through a period of slow growth. And if we do this the right way, with a little bit of pain, we can create the foundations for a good prosperity. We'll never hear that again.
Yeah, because I want to give the element of compassion. A lot of people were really traumatized. Suicide rates go up. It is truly a horror show when recessions happen, and my heart goes out to them. And I actually believe that if you spoke honestly about it, private sector funds would flow, the charity would flow, because a lot of people are innocently affected. Although, of course, a lot of people were greedily buying those mortgages. All of that's true too. However, there's a lot of pain, a lot of suffering, and we don't want to let the government.
Let's mention in closing here that the great thing happened in October of 2008. Was it October of 2008? Right. The white paper was released for this new thing called Bitcoin, and then the Genesis block came in January, and as a way of creating a new, how do you say, safe haven for your assets, given the obvious failures of government. So that is a beautiful market response. It's like, in the past, we would always rely on gold or Oriental rugs or some other hard assets or something like that. Now we have, in the digital age, a new type of hard asset to correct for the failures of obvious failures of government. And I'm curious what's going to happen, because there will come another financial crisis in time. In fact, maybe sooner rather than later, because we've done nothing to correct the problems that led to 2008. We've made them worse, in fact. We still have moral hazard baked into the system. We still have kind of a quasi-nationalized system of mortgages and subsidies, and we have too big to fail institutions. All the conditions that led to 2008 are still with us, and worsened in a way because we piled on this Dodd-Frank regulations, which have done nothing whatsoever to do for anything. It's a Marxist piece of legislation, as far as I'm concerned. But the difference is, the next time we've got crypto. And that is going to be interesting to watch.
Good. Well, that's a fascinating point. I want to comment into it. First of all, picking up on not your nuance, but your perspective. I actually like your point that that the turning point of 2001, that we were moving, bad things were already beginning to happen. Mortgage risks and initiatives were already being taken. However, it's certainly the numbers show that it was only subsequent to 2001 that the craze really happened. The Fed funds rate at 1%, the aggressive feelings of George W. We need to subsidize housing, all of that. And it's very possible that that's one overlooked element, because all of us who went through 2001 know that it was almost a turning point in our lives. Whenever I read about when somebody dies, I always make a mental note. Did they just die before September 11, 2001, or afterwards? Did they know what was going to happen? And so indeed, it was a turning point in our consciousness. And your point that we shouldn't underestimate how it might have affected Greenspan.
Affected your point, and I agree with you completely. And I'm glad. You're the only other person I've heard to make it, and we rarely can. I mean, there's the relationship.
The data bear it out.
The relationship between U.S. foreign policy and the financial crisis of 2008, that is lost on most everyone, but there it is. And it's really interesting.
picking up on your movement going forward, and I just want to comment. You know, you always have to have. I like your point about Bitcoin ending on the Bitcoin note. Bitcoin will be there, and maybe the ball game will be different when Bitcoin is there. I have argued that I do see obviously increased risks of another recession, but I don't see bubbles. I mean, because I've got the green eye shade approach, looking at what's overpriced, stock market, housing market, and so I don't think that the next recession is going to be quite as bad as the 08 and 09 was. And I'll go on record saying that you think it could be just as bad. You may be right. Let's see.
Well, and I tell you what, I'm superstitious about this, but when you have a president engaging in this aggressive protectionism and disturbing the global supply chains to the extent that he's doing, I think it's very serious. The markets are doing their best to go, no, this doesn't matter. But, you know, I just don't know. I'm worried about that. And I think it's potentially could kick off the next financial crisis.
You're going to have the final word. Thank you, Naomi. Thank you, Jeff.
Thank you both so much. I do want to mention, I'm just looking at Twitter. So, Gene, actually, one of your articles was just retweeted by Steven Pinker, who's a best-selling author.
Oh, really?
So you talked about Stiglitz making projections and being utterly wrong about projections, but being unrepentant and still never in doubt about that. So I think, I mean, we see a lot of that in the financial crisis as well.
Nice.
Just all these people who are saying, you know, this is... I mean, you had Peter Schiff, who was calling it out for years and years, right? Who was saying this is going to collapse, and everyone had him on as this laughing stock, saying, this is never going to happen. You talk to the Fed chairman, he says everything is fine. Like, you're an idiot. And then what happens? You know, it all goes down the tube. So I just think that you've got to be careful trusting these so-called economists who are making these predictions, who just have a track record of being terrible. And just like to shout out about that, I'm actually going on the Contra Krugman cruise soon as well. So that's all about hating on Krugman, who is always making terrible predictions about things as well.
With the great Bob Murphy, that's going to be great. The Contra Krugman. People should read.
Bob Murphy is a fun guy.
Very deeply well-informed, Bob Murphy, about the very questions that we've just raised about how they responded to the crisis. So,
but I mean, lots of people have been very interested in this topic, and actually they're wondering whether we will rekindle our Austrian economics reading group, Gene, because they're super interested in learning more about this. A lot of people who are saying that they've come to Bitcoin through they've come to Austrian economics because they learned about Bitcoin. I think that's wonderful. So I would like to. Exactly. Bitcoin's the new Ron Paul revolution. So that's definitely something that I would love to consider, because it's just so helpful to have all these wonderful resources. You know, Thomas Sowell's written a lot about the housing crisis in particular that really helped inform my economic understanding. So
that was
just
a great
sharing
book by
those.
Sowell. Yeah, the housing boom and bust. A very, very very good book. Yeah,
for sure. So sharing those with people, I think, could be really helpful. But thank you both so much for being here, and thank you to everyone for being on the chat there. I'll give you more details about the reading group if Gene and I restart it, maybe an online version so you can all join. I'll put that in my Telegram group, and I'll share the article in the live stream to Steven Pinker's tweet, so you can see that. And thank you everyone for being here and chatting. And Jeffrey, thank you for letting me be here at AIER.
It's a pleasure.
It's wonderful. I'm in a ballroom at the moment, guys.
The maintenance cost on that place is a fortune.
Absolutely. I wouldn't advise anyone buying a castle.
I don't think you know how many rooms. What is it, 19 or 64 rooms? It's a men's place. Anyway,
I went exploring and I couldn't count the rooms. And then I got distracted by all the ghosts here. No, that's a lie.
It's one ghost.
One
just
ghost.
one.
Okay, yes, indeed. There's only one ghost. Thanks, guys.
People say it has a spouse. Okay,
bye-bye. All right, thanks, everyone. Have a great day.
Bye-bye.